Jesse Livermore made $100 million shorting the 1,929 crash, equivalent to $3 billion today. By 1940, he was dead by his own hand, broke and broken. Here's the brutal truth that separates amateurs from professionals. Livermore didn't fail because he couldn't read the tape. He failed because he violated one mathematical principle that every professional trader lives by. But most amateurs ignore until it's too late. You're about to discover why 90% of traders blow up their accounts within 2 years. It's not bad entries or poor timing. It's not even emotional discipline around individual trades. It's something far more insidious: the inability to manage position size mathematically, especially after big wins. The statistics are devastating. Within 24 months, 9 out of 10 trading accounts are wiped out completely. Not reduced, not damaged, obliterated. These aren't beginners making obvious mistakes. Many are intelligent people who understand technical analysis, who can read charts, who know when to buy and sell. Amateur traders think bigger positions equal bigger profits. Professional traders know bigger positions equal bigger risks of total ruin. The difference isn't courage or market knowledge, it's adherence to one simple rule that Livermore understood intellectually but failed to implement emotionally when his ego was riding high. Walk into any trading floor, speak to any professional who survived multiple market cycles, and they'll tell you the same thing. Position size kills more traders than bad stock picks ever will. This isn't about stop losses or chart patterns. Every trader knows those basics. This is about the hidden mathematics of survival that transforms trading from gambling into a repeatable business process. Livermore called it the hardest game in the world because the enemy isn't the market, it's your own psychology after you start winning. Here's what most traders don't understand about the mathematics of ruin. If you lose 50% of your account, you need a 100% gain just to break even. Lose 75%? You need a 300% gain to recover your original capital. These aren't just numbers, they're mathematical death sentences that explain why most traders never recover from their first major loss. The arithmetic is unforgiving, and it compounds against you exponentially with each oversized position that goes wrong. Consider what happened to Livermore after his greatest triumph. Success became his poison. After making $100 million, Livermore began taking positions that represented 25%, 50%, even 75% of his entire net worth on single trades. He confused his ability to read market direction with immunity from mathematical ruin. This is the trap that destroys careers. You make money, you feel invincible, you increase your bet size, and eventually the market humbles you in ways that smaller positions never could. The rule is elegantly simple. Never risk more than 1% of your capital on any single trade. 1%, not 5% on your best ideas. Not 10% when you're absolutely certain. Not 20% when you feel like you're on a hot streak. Livermore routinely risked 25%, 50%, even 75% of his fortune on individual positions. He confused conviction with mathematics, certainty with safety. Here's a scenario that plays out daily. Mark opens an account with $50,000. He starts disciplined, risks 1% per trade, and after 6 months he's up 25%. His account sits at $62,500. He feels invincible. He spots a setup he's certain will work. Instead of maintaining his 1% risk, which would be $625, he risks 20% of his account, a staggering $12,500. The trade gaps against him overnight. His $12,500 disappears. Now he needs a 25% return on his remaining capital just to break even. The psychological pressure becomes immense. Professional traders understand this arithmetic viscerally. They've seen brilliant analysts destroy themselves not through bad analysis, but through bad sizing. They know that being right about market direction means nothing if you're wrong about position size. When you risk large percentages of your capital, every market tick becomes emotional warfare. Fear clouds judgment. Greed overrides discipline. The tape that once spoke clearly becomes a blur of self-justification and hope. The 1% rule isn't conservative trading. It's survival insurance that ensures you can be wrong 50 times in a row and still have half your capital intact. This mathematical principle transforms your mindset from a gambler seeking one big score to a business owner managing ongoing risk. Your trading career isn't a sprint, it's a marathon, and the 1% rule is the essential endurance strategy. By the end of this video, you'll understand the exact mathematical principle that could have preserved Livermore's wealth. You'll learn why even the greatest trader in history couldn't master his own success. And you'll discover the complete protocol that separates survivors from casualties in this unforgiving game. You'll see the specific formula professional traders use to calculate position size, the psychological traps that make even disciplined traders violate the rule, and the systematic approach that transforms the 1% principle from a constraint into a profit amplification system. The mathematics are simple. Following them is not. Here's what killed Livermore. He never learned the difference between being right about direction and staying alive mathematically. The 1% rule isn't conservative trading, it's survival mathematics that ensures you can be wrong 50 times in a row and still have half your capital intact. This isn't theoretical. If you consistently risk only 1% of your trading capital on any single trade, a string of 50 consecutive losses would reduce your account by roughly 40%. You'd still be dangerous, still be learning, still be positioned to capitalize on the next major opportunity. Most traders risk far more and vanish long before they gain the experience necessary to become consistently profitable. Consider the brutal arithmetic of drawdowns that destroys trading careers daily. If you lose 10% of your account, you need an 11.1% gain to recover. Lose 20%, you need a 25% gain. Lose 30%, you need a 42.8% gain. Lose 50% of your account, you need a 100% gain just to break even. Lose 75%, you need a 300% gain to recover. These aren't just numbers, they're mathematical death sentences that explain why most traders never recover from their first major loss. The recovery requirements accelerate exponentially with each percentage point of loss, creating psychological pressure that forces increasingly desperate decisions. Professional traders calculate position size using this formula. Never their emotions. Position size equals account value times 1%. Entry price stop loss price. Position size equals entry price stop loss price account value times 1%. Let's break this down with concrete numbers. You have a 100,000 trading account. You identify a stock trading at $50 per share with a logical stop loss at $48 per share based on technical structure. Your risk per share is $2. Using the formula $text shares equals frac $1,000, $2 equals 500. Text shares $. You can buy exactly 500 shares, not 600 shares because you feel confident. Not 800 shares because your analysis is thorough. Not 1,000 shares because you're certain about the direction. The mathematics determine the size, period. This objective calculation removes the biggest variable that leads to emotional trading, your subjective confidence level. Livermore understood this intellectually. In 1907, he made $3 million shorting the panic, but he did it with proper position sizing. He built positions gradually, scaled into weakness with confirmation, and maintained mathematical discipline throughout the process. The success, however, planted the seeds of his destruction. After 1929, he began risking massive percentages of his capital, believing his market genius made him immune to the mathematics of ruin. This is the classic trap. Past success becomes justification for future recklessness. Here's the scenario that destroys careers systematically. You start with $100,000 and risk 20% on a sure thing. You lose. Your account drops to $80,000. To get back to break even, you now need a 25% gain on your remaining capital. You risk another 20% of your current balance, $16,000, and lose again. Your account falls to $64,000. Now you need a 56.25% gain just to recover your original $100,000. The mathematics compound against you exponentially. One more 20% loss brings you to $51,200, requiring a 95.3% gain to break even. Each loss makes recovery exponentially more difficult, creating psychological desperation that forces larger, more reckless positions. Amateur traders see a 90% conviction setup and bet everything. Professional traders see the same setup and bet 1%. The amateur says, "I can't lose on this one." The professional says, "I can't afford to lose everything if I'm wrong." This mindset difference is everything. The amateur focuses on the probability of being right. The professional focuses on the consequences of being wrong. Both might have identical analytical skills, but their approach to risk creates entirely different outcomes over time. The 1% rule transforms every trade into a business decision rather than an emotional gamble. It removes the psychological pressure that forces premature exits and clouds judgment. When you risk 1% per trade, losses become manageable business expenses rather than life-altering catastrophes. You can think clearly about market structure, hold positions appropriately based on technical levels, and make rational decisions about exits based on price action rather than fear. Consider the emotional difference in practice. Risk 1% and watch your position move against you. It's annoying but manageable. Your breathing stays normal. Your decision-making remains clear. You can objectively assess whether to hold based on your original thesis or cut the loss and move on. Risk 20% and watch the same adverse movement. Your heart rate spikes. Your judgment becomes clouded. You start checking quotes obsessively. You exit prematurely based on fear or hold too long based on hope rather than objective analysis. Here's a real-world example that illustrates the difference. Sarah, a disciplined swing trader with a $200,000 account, sizes every entry at 1% risk using the mathematical formula. Over 4 months, she takes 40 trades, wins 17, and loses 23. Her average loser costs exactly 1 R. Her average winner gains 2. 4R. She finishes up 15% while sleeping well every night. When a sharp correction hits in month 5, 3 consecutive losses barely register because her total risk exposure never exceeds 2% of her account. Resilience becomes her edge, not prediction. Contrast that with Marcus, a gifted chartist who risks 8% whenever a setup feels perfect. He scores 2 big wins early and swells with confidence. Then a gap down through his stop slashes equity by double digits. He widens the next stop to avoid similar pain, gets clipped again, and spirals into larger positions to make it back quickly. Same charts, same market, different mathematics. One survives because downside is engineered. The other perishes because conviction outran arithmetic. But there's a psychological component to this rule that even mathematically disciplined traders struggle with. And it's what we'll explore next. The most dangerous moment in any trader's career isn't after a devastating loss, it's after a spectacular win. This is the paradox of prosperity that destroyed Livermore. And it's the psychological trap that makes the 1% rule so difficult to follow when you need it most. Success creates a dangerous cocktail of validation, euphoria, and invincibility that transforms disciplined professionals into reckless amateurs overnight. The statistics bear this out. Traders are more likely to blow up their accounts in the 6 months following their biggest win than in the 6 months following their biggest loss. After his 1929 triumph, Livermore fell victim to what professionals call success drift. The euphoria of being right, the validation of genius, the intoxicating taste of easy money. It all conspires to make you believe the rules no longer apply. Amateur traders increase position size when they're winning, thinking they're on a roll. Professional traders maintain mathematical discipline regardless of recent results. This isn't natural human behavior. Every instinct screams to press your advantage when you're winning, to bet bigger when you're hot, to capitalize on your streak of brilliance. Pride becomes a bad risk manager. Here's the insidious psychology at work. When you risk 1% per trade, losses feel manageable and decision-making stays rational. Your breathing remains normal. You can objectively assess market structure, hold positions based on technical levels rather than fear, and make exit decisions based on price action rather than emotion. When you start risking 5%, 10%, or 20% because you're feeling confident, every market tick becomes emotional warfare. Fear clouds judgment, greed overrides discipline. The tape that once spoke clearly becomes a blur of self-justification and hope. Consider this scenario that plays out daily across thousands of trading accounts. You start the year with $100,000 and maintain strict 1% position sizing discipline. By July, you're up 30% using methodical risk management. Your account sits at $130,000. You've taken 85 trades, won 34, lost 51, but your winners averaged 8R, while your losers stayed at exactly 1R. The mathematics worked perfectly. Then you spot what looks like a guaranteed setup. The chart pattern is textbook perfect. The fundamentals align. The technical indicators confirm. The amateur doubles their bet to 2% because they're feeling invincible. After all, they're up 30% for the year. Clearly, they've mastered the markets. The professional maintains 1% because confidence is dangerous. When that guaranteed setup fails, and they all do, eventually the amateur's overconfidence turns into a career-threatening loss. That 2% position, sized on a $130,000 account, represents a $2,600 loss. The psychological pressure becomes immense. The amateur, now shaken, faces a choice: admit the mistake, or double down to make it back quickly. Success drift has corrupted their judgment. They choose the latter. Livermore's 1,929 fortune came from one massive position during the crash. Instead of taking profits and returning to normal sizing, he held and even added to oversized positions. His ego, inflated by spectacular success, convinced him that his market genius made normal risk management obsolete. When the inevitable bounce came in 1930, his bloated risk exposure destroyed years of disciplined gains in mere weeks. The man who made $100 million shorting the crash lost it all because he couldn't scale back to mathematical discipline after his greatest triumph. Here's what happened specifically. After his 1929 windfall, Livermore maintained positions that represented 40%, 50%, even 60% of his total net worth. When the market rallied sharply in early 1930, a perfectly normal technical bounce after such severe decline, his oversized short positions created catastrophic losses. The same analytical skills that made him rich became weapons of destruction because his position sizing had shifted from mathematical to emotional. The psychological truth cuts deep. Your biggest victory can become your deadliest enemy if not managed with mathematical precision. Success breeds overconfidence. Overconfidence breeds oversizing, and oversizing breeds ruin. This cycle has destroyed more talented traders than bad analysis ever could. The irony is devastating. The better you become at reading markets, the more dangerous success becomes, because your ego starts believing you're above the mathematics of survival. Professional traders think like casino owners, not gamblers. Casinos don't bet everything on one hand, no matter how favorable the odds appear. They make consistent, mathematically advantaged bets over thousands of transactions, knowing that their edge emerges through volume and discipline, not through individual spectacular wins. A casino never increases its bet size because it's feeling lucky or because the last 10 hands went well. The house edge is mathematical, not emotional. Consider Elena, who had a clean year up 24% by May, risking 1% per idea. Then a breakout lit up her screen. She widened the stop to avoid noise, doubled position size just this once, and skipped waiting for confirmation. The stock gapped below her stop and clipped her for 6% in 2 sessions. One decision broke the dam. Contrast that with Daniel, who treats excitement like a red flag. After a big month, he cuts risk to 0.5% for 2 weeks, forces himself to wait for confirmation, and journals the urge to oversize. Waiting is a position. Patience pays. The paradox in one sentence: the win that should earn you caution usually buys you recklessness. Guard against that with rules you don't negotiate. Your edge isn't prediction, it's staying solvent long enough to let discipline compound. Next, we'll explore the exact protocol professionals use to implement the 1% rule, even when their psychology is working against them. Knowing the 1% rule and following it consistently are completely different skills. Here's the exact three-step protocol professional traders use to implement mathematical position sizing, even when their emotions are screaming otherwise. The gap between intellectual understanding and consistent execution destroys more trading careers than poor market analysis ever could. You can memorize every formula, understand every principle, and still find yourself violating the rules when real money is at stake and conviction runs high. This isn't your total account value, it's money you can afford to lose completely without affecting your lifestyle. Most traders make a fatal error here by confusing account size with risk capital. If you have $100,000 in your trading account but need $80,000 for emergencies, living expenses, and financial obligations, your true risk capital is only $20,000. With $20,000 risk capital, 1% equals $200 per trade maximum loss, not the $1,000 that amateur traders calculate based on total account value. This distinction is crucial because it forces you to confront the reality of your financial situation. Professional traders separate their trading capital from their life capital completely. They never risk money they need for rent, mortgage payments, or emergency funds. This psychological separation allows them to make rational decisions under pressure, because the outcome of any single trade cannot affect their standard of living. Consider Michael, who started with $50,000 but determined his true risk capital was only $15,000 after accounting for upcoming expenses. His maximum risk per trade became $150, forcing smaller positions but creating psychological freedom. When positions moved against him, he could think clearly because his lifestyle wasn't threatened. This mental clarity is the foundation of consistent performance. Use this formula religiously. Never your emotions. Text shares equals frac, text risk amount, text entry price, text stop loss price. If your maximum risk is $200 and your stop loss creates a $2 per share risk, you can buy exactly 100 shares. If your stop creates a $4 risk per share, you can only buy 50 shares. The mathematics determine size, period. Not your feelings about the setup, not your confidence level, not your conviction about market direction. Let's walk through a concrete example. Your risk capital is $30,000, making your maximum risk per trade $300. You identify a stock at $75 with a logical stop at $72 based on technical structure. Your risk per share is $3. Using the formula dollar text shares equals frac $300, $3 equals $100, text shares, dollar, you buy exactly 100 shares, investing $7,500 total. Your maximum loss is predetermined at $300. The outcome is binary and manageable because the mathematics controlled the sizing decision, removing all subjectivity from the process. Amateur traders enter positions and then decide where to exit based on how they feel as the trade develops. Professional traders reverse this sequence entirely. They decide where to exit before they enter and then determine if the position size makes mathematical sense given that exit point. If proper stop placement forces a trivially small position, say 10 shares of a $200 stock pass on the trade entirely. Waiting is a position. This reversal of sequence is critical. By defining your exit first, you remove the emotional decision-making that occurs when money is at risk. You're not hoping the position will work out or trying to give it a little more room when it moves against you. Your exit is predetermined based on objective technical levels, not subjective comfort levels. Here's the counterintuitive truth that saves careers. Smaller position sizes actually increase total returns over time. With 1% risk per trade, you can afford to take more high-probability setups because no single loss threatens your survival. You can hold positions longer without emotional pressure because the downside is manageable. You avoid the psychological mistakes that force premature exits when positions move temporarily against you but remain technically sound. The mathematics prove this point. Trader A risks 10% per trade and wins 60% of the time with a 2-to-1 reward to risk ratio. After 100 trades, despite his high win rate, he's likely broke due to the devastating impact of losing streaks. Trader B risks 1% per trade with the same statistics. After 100 trades, He's consistently profitable because his losses never compound into career-ending drawdowns. The protocol removes emotion from sizing decisions entirely. You're not deciding how much to risk based on conviction or confidence. You're following a mathematical formula that ensures survival regardless of outcome. This systematic approach transforms trading from an emotional roller coaster into a mechanical business process where your edge emerges through repetition and discipline. Here's an anecdote that illustrates the difference. Nina trades with $40,000 risk capital, risking $400 per trade. She wants a breakout at $75 with stop at $73.80, creating $1.20 risk per share. The formula allows 333 shares. She rounds to 300. When the stock confirms with volume, she adds another 300 shares with her stop lifted to break even. She takes partial profits at 2R and trails the rest. Her month closes up 9.2% with maximum drawdown of 2.1% because position size never outran volatility. Contrast that with Max, who trades the same setups but sizes based on conviction, risking about 10% when it's obvious. 2 consecutive losses shrink his account 19%. He then chases a rebound with wider stops and gives back another 7%. Same markets, opposite outcomes. Implementation, not insight, decides survival. Livermore understood market analysis but failed at implementation discipline. He would identify perfect setups with professional-level analysis, then execute them with amateur-level position sizing. His technical skills were world-class. His risk management was catastrophic. He could read tape better than anyone but size positions based on conviction rather than mathematics. The complete system requires one additional element that transforms the 1% rule from defensive protection into offensive profit amplification. And that's what we'll cover next. The 1% rule isn't just defensive protection, it's the foundation for systematic profit amplification through what Livermore called pyramiding. Professional traders don't just follow the 1% rule. They scale into winning positions using multiple 1% increments, transforming mathematical safety into explosive profit potential. This is where amateur traders and professionals diverge most dramatically. Amateurs front-load conviction and pray for results. Professionals add on proof, letting the market invite them into larger positions one confirmed step at a time. Here's how systematic scaling works in practice. Identify a high-probability setup and take your initial 1% position with a stop below the pivotal point. If the market confirms your thesis with objective price action breaking resistance on volume, gapping in your favor with follow-through, showing sustained momentum above key levels, add a second 1% position. If confirmation continues, add a third. Your total risk reaches 3%, but your profit potential has tripled because you're building size as the market proves you right, not because you hope you're right. Consider the mathematical beauty. Your account holds $100,000, making each 1% position worth $1,000 maximum risk. You buy 500 shares at $50 with stop at $48, exactly $1,000 risk. Stock breaks through $52 resistance on heavy volume. You add 500 more shares. But now your first position shows $1,000 unrealized profit. Psychologically, you're risking the market's money, not fresh capital. Stock pushes to $56 with continued momentum. You add your final 500 shares. Total exposure, 1,500 shares. Maximum risk if everything fails. Still just your original $1,000 because subsequent additions were funded by paper profits. The psychological breakthrough transforms everything. When you scale systematically, early profits fund additional risk. You're literally trading with the market's money, not your own capital. This removes the emotional pressure that destroys decision-making and allows you to hold winning positions longer. Fear diminishes because your downside remains capped while your upside expands with each confirmation. Amateur traders do the opposite. They take large initial positions based on conviction, then refuse to add when proven right because they're fully invested. When wrong, they average down, increasing size as losses mount. Always start with 1% risk. Stop below pivotal point based on clean technical structure. Never pyramid into setups without defined risk parameters. Add only after objective market validation. Volume breakout above resistance. Gap follow-through with sustained buying. Momentum continuation with higher highs and lows. Never add on hope, intuition, or because you like the setup more. Fund additional positions with unrealized profits. Never exceed 3% total account risk across all pyramid positions. If your first position hasn't generated 1R profit, you cannot add. Trail stops under higher lows or structural support as positions develop. Tighten stops to protect accumulated gains while allowing room for normal volatility. Scale out systematically at 2R and 3R levels. Let remainder run with trailing stop. This locks in profits while maintaining upside exposure. Livermore understood pyramiding intellectually and wrote about it extensively. In his early career, he executed it brilliantly, building substantial positions through disciplined additions on confirmation. His fatal flaw emerged later. He scaled into positions correctly but ignored exit discipline entirely. He would build 20% or 30% positions through methodical pyramiding, then hold through reversals instead of scaling out systematically. His ego convinced him that if he was smart enough to build the position, he was smart enough to hold it indefinitely. This thinking destroyed multiple fortunes. Here's an anecdote that illustrates the difference between professional and amateur pyramiding. David, a trader I coached, caught a semiconductor breakout at $85. He took his initial 1% position with stop at $82. Stock confirmed with volume, breaking $88 resistance, he added 1%. Momentum continued to $92, he added his final 1%. Total risk, 3%. Over 6 weeks, systematic scaling generated 12R return as the stock ran to $125. He scaled out at 2R and 4R, letting his final third trail until the trend broke. The next month, David spotted a beaten-down biotech and took his standard 1% position. The stock immediately broke his stop. His amateur instinct screamed to average down. The fundamentals looked solid. The sell-off seemed overdone, but his protocol saved him. He couldn't add to a loser because his system only allowed additions on confirmation, not hope. He took the 1% loss and moved on. This single rule, never add to weakness, kept his equity curve stable while others who averaged down suffered devastating losses. The mathematics create asymmetric risk-reward profiles that transform the 1% rule from constraint into profit engine. Maximum loss remains capped at 1% to 3%, but maximum gain becomes unlimited as trends develop. Professional traders understand that big money isn't made through big initial positions, it's made through small initial positions that grow systematically as the market confirms their thesis. Amateur traders see pyramiding as license to go all in. Professional traders see it as controlled aggression, funded by free carry, guarded by stops, and governed by fixed risk budgets. The difference is protocol, not talent. Add on strength, reduce on weakness, cut losers without debate. Pyramiding is insurance-funded aggression, not ego-fueled overexposure. The complete system transforms the 1% rule from defensive protection into offensive profit amplification. But it requires one final element, a pre-market ritual that makes discipline automatic rather than dependent on willpower. Jesse Livermore died in 1940 with 8 cents in his pocket, having made and lost multiple fortunes. His suicide note read, "My life has been a failure." The greatest trader in history couldn't master the one element that would have preserved his wealth: systematic implementation of mathematical position sizing through all market cycles. This wasn't a failure of market analysis or timing. Livermore could read tape better than anyone alive. This was a failure of systematic discipline. The inability to follow a mathematical protocol when emotions ran high and conviction felt absolute. Here's the 10-minute pre-market ritual that makes the 1% rule automatic rather than dependent on willpower. Ritual beats motivation because ritual fires when emotions misfire. You will execute this sequence when you're excited about a setup, when you're scared after losses, when you're confident after wins. The protocol never changes because professionals standardize what amateurs improvise. This systematic approach transforms trading from emotional decision-making into mechanical business process, where discipline emerges from structure, not strength of character. Begin each trading day with an account snapshot. Record your current balance, review your last 20 trade results, and assess any circuit breaker conditions. Are you in drawdown mode? Have you violated risk rules recently? This objective assessment prevents emotional trading based on yesterday's outcomes. Write the numbers down. Psychological accountability starts with mathematical honesty. If your rolling 20 trades show a drawdown exceeding 6%, activate your circuit breaker and reduce base position risk from 1% to 0.5% until you record 3 profitable trades or drawdown shrinks below 3%. Establish your position sizing baseline at 1% risk per trade, automatically reducing to 0.5% during drawdown periods. Set your daily risk budget at maximum 2% of account value if 1% losses hit. Your trading day ends regardless of potential setups. Maintain maximum 3% total open risk across all active positions. These mathematical constraints prevent overexposure during emotional periods when perfect setups seem to multiply. Professional traders cap risk first, then hunt opportunity. Amateurs reverse that sequence and pay for it. Apply rigorous setup filtration by trading only securities showing clear tape alignment above rising moving averages for long positions, below falling averages for short positions. Avoid choppy, directionless markets where your edge diminishes significantly. For every potential trade, write your thesis in one concise sentence and define the exact pivotal point where your thesis fails. Example: long XYZ, above $50 breakout on volume, targeting $58. Thesis fails below $48.50. This forces clarity and eliminates the rationalization that keeps you in losing positions beyond logical stop points. Calculate position size using the mathematical formula religiously. Position size equals account value times risk, percentage entry price stop loss price. Position size equals entry price stop loss price account value times risk percentage. If the calculated position yields trivially small share counts fewer than 100 shares of a reasonable stock, skip the trade entirely. Don't force positions that fail mathematical criteria. The market is telling you the structure doesn't support your risk budget. Respect that message. Waiting is a position, and patience pays compound interest over time. Predefine confirmation levels for pyramid additions before taking initial entries. Map exactly where you would add second and third 1% positions, but only after objective market validation, volume breakouts, gap follow-through, sustained momentum. Fund these additions solely with open profits from initial positions, never fresh capital. This ensures maximum account risk never exceeds 3%, even as position size grows systematically with market confirmation. Establish exit discipline by planning profit-taking levels at 2R and 3R before entry. Commit to trailing stops under structural support as positions develop. Never allow 2R winners to become losers. This single rule protects more capital than any other technique. Scale out systematically rather than hoping every trade becomes a home run. Professional traders understand that consistent singles and doubles compound faster than swinging for rare grand slams. Conduct an emotional checkpoint before placing orders. Rate your anxiety and greed levels from 1 to 10. If either exceeds 7, immediately cut planned risk in half or stand aside entirely. High emotional states correlate directly with poor decision-making. Your physiology tells truths your brain will rationalize away. If your hands shake entering orders, your position size is wrong. If you feel euphoric after recent wins, your next position size will likely be wrong. Verify lifestyle alignment by ensuring annual expenses remain below 6% of trailing equity averages. This creates financial buffer, preventing lifestyle pressure from corrupting trading decisions. You cannot trade objectively when you need specific outcomes for rent or mortgage payments. Trading should support your lifestyle. Never dictate it through forced performance pressure. This ritual removes emotion and willpower from the equation entirely. You're not deciding whether to follow rules based on conviction about setups. You're executing a mathematical protocol, ensuring survival regardless of market conditions. The system thinks for you, protecting you from yourself. When confidence runs high and discipline runs low, Livermore's principles about reading tape, following trends, and managing emotions remain timeless. His insights into market psychology and price action are still invaluable today. But without the foundation of mathematical position sizing, These skills become weapons of self-destruction rather than wealth creation. He possessed unparalleled market intuition, yet couldn't systematically implement the discipline that would have preserved his fortunes across multiple market cycles. Your edge isn't your ability to pick winners, it's your ability to lose small and win big consistently over hundreds of trades. The 1% rule ensures no single trade can destroy your ability to take the next one, granting you the ultimate trading currency: staying power. Cut losses fast, size small, pyramid on proof, wait for confirmation. Own your process, not your outcomes. These principles, applied systematically through unyielding daily ritual, transform trading from gambling into sustainable business. Livermore mastered market analysis but failed at systematic implementation. Don't repeat his tragedy.